Yeah, I'd take a lower IRR if the deal's less risky, or if it is less time consuming for me. If it's a longer hold, and I think, well, if I couldn't sell this thing in a couple of years, what am I going to do with that money? But if I've got a 10-year or 15-year deal that I just have to place the money and let it go, then that's another reason to take lower IRR, higher cash on cash, like you were saying, because then you can take that cash and you can reinvest it rather than getting it at the end.
What is up, and welcome back to How to Invest in Commercial Real Estate. My name is Braden. I'm with Brian and Joel, and today we're going to talk a little bit about internal rate of return.
What is going on, guys?
What's up?
Not much.
So today could be a doozy because internal rate of return is insanely complicated. To define it, we're going to have to use words that are also complicated. So just bear with us, and then we will get to the point of how we use it. I mean, that's the big thing. Internal rate of return is a great metric to evaluate real estate. It's a very common metric to evaluate commercial real estate and a bunch of other investments in general.
Why don't we start with the actual definition?
Yeah.
All right. Go, Joel.
No, I think Braden's going to read it to us.
All right, Braden, what's the actual definition?
Yeah, so the internal rate of return is a discount rate that brings all of the cash flows down to zero, technically speaking.
Net present value of zero.
Correct.
Well, I think it's all the cash flows of the investment. The net present value of all of those equals zero, including the original investment.
Correct.
Mm-hmm. Yeah.
So that's kind of complicated. The discount rate is just what return you're getting on your money.
Mm-hmm. The assumed return you would want, yeah.
And we've talked about it before, but the time value of money is really important in real estate because not only how much money you make in a real estate deal is important, but when you get it is also important. Mm-hmm. And so that's what internal rate of return is doing. It's taking a future cash flow and it's bringing it back as if you invested a certain amount at let's say a 10% discount rate. It's bringing that back to day one.
Right.
And that way you can evaluate different real estate deals. Maybe one is front loaded with some cash flow. Maybe one has a huge sales price at the end, or you're building equity quicker because of the loan. And it brings all those back to day one and makes them even playing field to see, okay, which one is actually getting me a better return.
Yeah.
Yeah. So, I think up until this point, we've talked a ton about commercial real estate and just real estate in general. It throws cash at you from every direction. You're getting appreciation, you're getting depreciation, you're getting cash flow, you have capital expenditures, you've got debt, you may get new debt in the middle of an investment, right? So the IRR is saying, okay, all of those cash flows, all of those activities going on, we're going to try to break that down to an annual rate of return that you as an investor would get over the time period that we're going to have your money. That's generally speaking what an IRR is, right?
Yeah, it's a little complicated to calculate, but yeah, it's kind of saying, hey, you're going to invest $50,000 with us, and you're going to be building equity along the way, and you're going to be getting some distributions along the way. Mm-hmm. Maybe there's a year you don't get any distributions, and then we sell the property and we make money. Well, how do I know exactly what my rate of return was?
Correct.
Because it wasn't like I was earning interest on that money every year. I was getting it at different times. So yeah, that's what it does. It's a way it calculates through bringing all the cash flows to a net present value of zero is what is that annual compounding average rate of return.
Yeah.
It's no different than what companies do every day, right? Company has a certain amount of money to spend. They're trying to decide, let's say it's a manufacturing company. And
let's say it's Tesla and they're deciding whether or not to manufacture cars or buy Bitcoin.
Yeah. Or maybe they need a new piece of equipment to assemble their cars. So they have a certain amount of investment on that piece of equipment, and then they want to see what their IRR is going to be.
Yeah.
And it's a good way to compare different investment strategies or different investment avenues.
Yeah. Yeah. You can compare it to what you can do in the market, in the stock market. Even businesses will do that. Sometimes if they're on a certain project, the IRR is too low, they're either going to find somewhere else to put their money, or they might invest the money themselves. In the market or something other than in their own company.
Yeah, or even a house flipper or something. Those guys may be not using as sophisticated formulas to calculate IRR, taking into account their capital expenditures and the debt and the actual cash flow it produces. They may be just looking at rental payment minus mortgage equals cash flow times 12, boom, 20%. When in reality it's 10 or whatever it is.
And so why do we use IRR? Because IRR is at least my favorite way to analyze commercial real estate.
Yes. One of my favorites is cash flow, which backs me into the reason, right? Because you have multiple deals. Some are paying you cash flow, some are not paying you cash flow. One's an existing building, one's a non-existent building that's going to be built. And you have to pay attention to the IRR because the IRR is telling you when and where kind of the money is coming from. If you have a deal with a 20% IRR, but it produces zero cash flow over the 3-year hold period, and then you just get a one lump sum of money, that's a completely different deal than an IRR. It could have the same IRR, but it's paying you 10, 12, 15% a year in cash flow. And then, at the end, there's only a little bit of money being made from the sale. That's kind of what it's telling me. I don't know if I answered your question or not.
Okay, well, IRR in those two cases, though, they may give you the same IRR, so over a 5-year period, you essentially made the same annual average compounding rate of return on your money.
Right.
So then the question then goes to your example is there a reason why you might take a lower IRR deal versus a higher IRR deal?
Yeah, I'd take a lower IRR if the deal's less risky or if it is less time consuming for me. If it's a longer hold, and I think, well, if I couldn't sell this thing in a couple of years, what am I going to do with that money? But if I've got a 10-year or 15-year deal that I just have to place the money and let it go, then that's another reason to take lower IRR, higher cash on cash, like you were saying, because then you can take that cash and you can reinvest it rather than getting it at the end.
Yeah. So here's a good
and
example.
It also makes your investment less risky, right? Because you're pulling the money out that you put into it.
That's a really good point.
Yeah.
Yeah. So if you're getting, if you're pitched a 20% IRR deal, but they're paying you 12% a year in cash flow, this is kind of the point I was driving to. Who cares if you get the extra 8?
Yeah.
You already killed it getting the 12.
Right.
And then if they're going to get you a pop when you sell this thing, that's a win. That's how they're getting you to 20. But if they were pitching you a 20% IRR on another deal and it paid, 4% in cash flow, but the 12% in cash flow deal had an IRR that was, maybe a few points less than that, you'd take the 12% in cash flow over the 4 if it was a few percent in the back end.
Sure.
Because who cares?
Yeah. Well, I mean, people might care. I think whenever you're getting cash flow today from investments, then that total IRR is less dependent on future events.
Yeah. And
so that's a big distinction between higher cash on cash deals versus lower cash on cash deals, but maybe have the same IRR, is that future IRR, so much of the return of the investment depends
on
sale price or market conditions 5, 6, 10 years from now.
Right.
So they're both good, but we tend to want to focus on higher cash on cash deals today. And to your point, Brian, is giving our investors distributions every quarter. They can reinvest that money. Mm-hmm. They can hold it in a money market and earn additional dollars,
right? Which
won't show up in the IRR we give them, but they could calculate what's called a modified IRR, where they're reinvesting the returns over time, maybe even in the stock market or something, and that would even increase the total return of the investment.
Yeah, or buy other real estate deals with that cash that's coming out of it. Really, really compound the return.
Yeah, and I mean, you can kind of, we talked about cap rates recently. So to kind of associate internal rate of return and cap rates, you really can't, which is the beauty about it. I mean, people are underwriting, really high IRRs, and they may be buying an apartment complex, let's say on a 5 cap, right? So it's paying out a few percent. They may be getting an interest-only loan. So it's, the first few years have a lot heavier cash flow. And then the principal payment kicks in. They lower the cash flow a little bit, maybe you go from double digits down to 6 or 7 or something like that. And then you have massive amounts of appreciation in an amazing market because you bought it in a 5 cap. It better be an amazing market.
Growth.
Mm-hmm. Rent growth. And then you get this big pop in the back end, along with heavy cash flow in the first few years, and then medium cash flow through the rest of the investment. And internal rate of return is really good at evaluating that because there's a lot of different ways where you're making money in a lot of different time periods. And like you said, you may go a year with amazing distributions, and then COVID may happen.
Yep. Well, good point. What was I going to say about that? Can't remember.
I'm sure it was good.
Yeah.
Well,
I've got something while you think. There's another metric that people use, and maybe we should mention it just so people don't get confused, and that's ROI, return on investment.
Yeah.
And the difference there, you guys may have some input on this, but to me, the difference there is that's something that at the end of the project you can determine, right? It's not a yearly thing. It's an overall return. So you simply take the money you put in divided by the money that you got out, and and that's your total return. So that's return on investment.
Yeah, and that doesn't have anything to do with time. Is the biggest distinguisher there. So
That's
internal rate of return has a time value with money. And my biggest thing, right, is everyone wants to go make $1 million, but you can make $1 million working at you can make $1 million working at McDonald's making minimum wage if you live long enough.
Yeah.
You know what I mean? Making $1 million is chump change. How do you make $1 million in a year? How do you make $1 million in a month? How do you make $1 million next week? That's what I want to know. And internal rate of return takes that how much money you made and it says, okay, you've got a clock, bud.
Yeah.
Yeah. When did you make it?
Exactly.
Yeah.
Well, the point I was going to say earlier was we should probably give some guidance on what are IRRs in the market right now. What are investors seeing? What are we seeing?
Yeah. Yeah. So I'll take the first stab.
Okay.
I would say if you can get mid to high teens internal rate of return on an apartment deal right now, there's an unlimited amount of money you can make. There's an unlimited amount of money that will invest with you. If you can get mid to high teens internal rate of return on a great apartment deal, you can fund it to the moon.
I would say IRR has been higher, for the last 10 years, and they're starting to trend downward as cap rates get compressed. I would say it used to be pretty routine to get 20, 25% IRR. Some deals, of course, may higher 30, 35, even 40.
Yeah.
Of course, it's hard to sustain that type of a return for multiple years because of the compounding nature of it. But
right.
So today, multifamily is tougher. I would say cash on cash is now 10 or slightly lower, and IRRs now are pushing down into the mid-teens. Even it's hard to get some that are even high teens.
It's hard to get above 15.
Yeah, right now that's what we're seeing. Obviously, there are some deals that are out there, but we're still striving to get 17, 18 on our deals. But it's just we haven't bought a ton of deals because it's not easy to do.
When you say 17, 18, you're still talking about multifamily, right? And that multifamily, or are you talking about what about retail and industrial? Are those IRRs a little higher right now because of multifamily being so compressed?
Yeah, they are higher.
Definitely. But when you look at, you have to be careful because you get too high on the IRR, and then people are asking what's wrong.
Well, with retail, it's the risk too. Retail is going to be slightly higher on returns because less people are funneling capital into retail.
Right. My point is that you don't need to underwrite to an insane IRR. If you're underwriting to a 25, underwriting mean like striving to get, I want to clarify that. If you're striving to underwrite a 25, 28% IRR, then you're assuming too much risk. And I would suggest to like dial your model back a little bit, assume a little less risk and give a more practical return. And if you knock it out of the park and give somebody 25 and you pitch 20, good for you, bro. But like, why set yourself up for failure?
Yeah. So going back to IRR is the actual return. You only know that number when the investment has been exited.
Yeah. Right.
Okay. Everything before that is a guess based on the sponsor's assumptions.
Right.
So I just want to make that clarification.
Assumptions.
Yeah.
Guesses.
Yeah. So because really you have to know all the cash flows, which means the final sale of the property and the distribution of the original investment back. Yeah. Only then do you back calculate and get an IRR.
Yeah. Right.
So to your point, Braden, when talking about don't oversell the IRR, investors need to understand what are the assumptions in the IRR that's being presented to me. And so how is he getting this thing cash flows X dollars a year? How, maybe the cash on cash is 10, 11. How are we getting to 18? Mm-hmm. Average compounding yearly return over 5 years, over 10 years. Well, they are making assumptions on rent growth, on exit cap. When I say exit cap, I really mean sale price.
But the multiple at which your NOI is trading for on the sale price.
Mm-hmm. And so those are the big things that drive the IRR, the actual IRR. Cash flow is some of it.
Yeah.
But all those assumptions that the final exit when a lot of the money is made,
mm-hmm.
that's what drives it. So that's what you got to be careful to watch and really understand what assumptions they're making.
Yeah.
It's a good point though, because IRR isn't everything. So I don't want people to get discouraged or, you don't have to have a track record of successful IRRs. What helps is cash flow. Cash flow can help mitigate or help overcome your difficulties with IRR, because when you're paying people a decent return, 10, 12% in cash flow, let's say, then they don't have to have the IRR. They're winning. They're getting cash. That's already a win. If you're finding deals that can pay your investors enough to be happy now without waiting for some assumption, that's a win for you and them. You're not measured on the performance of your crazy guesses. You know that you can go in and operate with this cash flow like now.
Right.
Yeah, you don't have to hit it out of the park on a sale price. You want to obviously get their money back, but let's say that you broke even on the sale price.
Yeah.
You didn't sell for any more. Well, you've been giving them 12% a year, and you've been paying down that mortgage, so they're going to be at 13, 14, 15% just right there with the cash flow.
Yeah.
Like I was saying earlier, it's if someone came and pitched me a 28% IRR, but I didn't get any cash flow for 5 years, that's a little bit, it's way more risky because I have no idea what's going to happen in the future. Whether I'm getting paid 12% a year, my risk is significantly lost. If I've had that deal for 6-7 years, I've got almost all my money back.
Yeah. I'd much rather at the end, let's say I have a 5 to 10 year deal, and all of a sudden at the end of 10 years, you realize, oh, I made a 10% IRR. That sucks. My money just I wasted it for the last 10 years. But if they're pitching something for 10 years and you're getting 10 or 12% cash on cash back, I'm fine. At the end, there was no more left, and all I did was make my 10 to 12%. I'd be disappointed. Maybe I'd be okay.
Yeah. And we've had investors tell us that, you know what I mean? Internal rate of return is a great metric to evaluating investments from businesses or personally. It's a great, especially a great metric when used in real estate. It's really common in real estate. It's going to be kind of hard to get in and talk the talk and walk the walk if you can't really understand IRR and effectively explain it to your investors. That's going to be a big hurdle for you. So
there's some good videos. This is just an intro to IRR, why we use it. We didn't want to get too much into the weeds, but there are videos that really go into the math of what's going on.
Yeah.
And so I encourage people to check that out.
I would also encourage you, if you're listening to the podcast right now, make sure to check us out on YouTube. You can see our beautiful faces. We stream this just for you. Brian, what else?
I think that's it.
All righty, guys. Well, thanks for joining us, and hopefully we understand internal rate of return or IRR a little better.
All right. Thanks. Till next time.
Yep.